In early 2026, the global economy stalled as the threat of a prolonged conflict between the US and Iran loomed over international supply chains. The conflict physically shut in 9 million barrels of daily oil production, turning the Strait of Hormuz into a narrow geographic bottleneck for a massive portion of the world's energy supply. With that supply removed from the market, Brent crude futures spiked, trading consistently above $100 a barrel. An oil supply shock of this magnitude has a reliable historical track record. It almost always forces an immediate recession and a severe market crash. Yet, despite the persistent geopolitical risk and the drain of energy costs, the broader stock market refused to buckle, creating a period of extreme and unsustainable economic tension. Even under the weight of a major oil crisis, the S&P 500 index only suffered a drawdown of less than 10%. While the overall index dipped, 17% forward earnings growth in the tech and AI sectors acted as a massive financial counterweight. Tech capital expenditures were reaching multi-decade highs, supported by profit margins that hit 15% during the peak of the energy crisis. This created a tug-of-war in the markets, the fear of a widening war struggling against the pull of substantial corporate profits. The market remained held in place, awaiting a single geopolitical catalyst to release the pressure and resolve the stalemate. That catalyst appeared when Iranian officials traveled to Islamabad to discuss new proposals for restarting peace talks with the United States. At the same time, diplomatic efforts secured an extended 3-week ceasefire in Lebanon. These developments immediately lowered the probability of a permanent closure of the Strait of Hormuz. On a trading floor, these talks in Pakistan trigger a reassessment of risk, prompting investors to strip away the geopolitical premium that had been depressing stock valuations. This shift triggered a sector divergence, where the prospect of peace sent different parts of the market in two opposing directions. Looking left at the old economy, reopened trade routes dropped U.S. natural gas 4% and WTI crude to $94. This energy plunge pulled the Dow Jones into negative territory. Conversely, on the new economy right, cheaper energy neutralized the threat of unanchored inflation. With inflation expectations cooling, traders calculated that the Federal Reserve would have more room to eventually lower interest rates. The response in the tech sector was immediate. Intel shares surged 23.6%, and Nvidia's market cap crossed $5 trillion. This influx of capital pushed both the Nasdaq and the S&P 500 to new record highs. The peace talks functioned as a mechanism for reallocating capital, moving funds out of defensive commodities and into high-growth technology. By removing the inflation bottleneck, the diplomatic shift acted as a financial release valve for the entire stock market. The AI boom had already reached critical mass. The diplomacy in Islamabad merely removed the obstacle preventing that capital from flowing. The data centers and profit margins were already in place, but their stock prices had been suppressed by a layer of geopolitical uncertainty. It was an information problem. Investors had the data on tech profits, but they couldn't act on it until the external friction of the conflict was gone. This phenomenon is the geopolitical risk premium, a heavy weight that holds down healthy markets during periods of global conflict. The chain of events is precise. Diplomacy stabilizes energy prices, which lowers inflation expectations, which then permits the tech sector to rally. Because of algorithmic trading and global connectivity, these shifts in capital now happen in milliseconds after a headline breaks. For the modern investor, monitoring global diplomacy is a study in friction, identifying the exact moment political constraints vanish, allowing the market to realign with its underlying data.